friends, I'm back. How many of you remember this aloe plant? I had this in my video back in 2017, actually in a few different videos. I was sitting outside in my backyard. I was at the wooden table at our old home in the Bay Area. 7+ years ago, I had this aloe plant. It was a lot smaller. Here it is. It's still here. It's doing really well. It's a lot bigger. It is thriving, just like my dividend stock investing portfolio. This aloe plant, I want to use this today as an analogy. This is an analogy of what dividend stock investing can be. We have nurtured this plant. We have watered this plant. We've fed this plant. We've reinvested more or less into this plant because we haven't really clipped the leaves to use the aloe. I think we did that once, but more or less it's been reinvesting and it just keeps growing like the dividend snowball from dividend stock investing. And oftentimes we ask ourselves in this community this question: is it still a viable strategy in 2025 to invest in core dividend stocks for the future? Are the prospects as good as they were back when I was filming those old school videos, the backyard videos in 2017? How are the prospects right now? Well, I did some analysis I want to share with you in the video today, and I am here to say I actually think the prospects are as good as they've ever been. But so many of us, myself included, we fool ourselves into thinking that the prospects are no good. We look at the media. We get roped into social media, the negativity. There's a lot of negativity out there. We start telling ourselves doubts as well. And I think part of that, for me at least, has been my age. As I get older, I'm a little more conservative, more pessimistic about the future, and then feed in a bunch of social media, and I'm even more negative about the future. But I look actually at the numbers that I want to share with you today. On two stocks, I'm actually going to cover, once again, Johnson & Johnson and PepsiCo. I want to cover those in the video today because when I look at the prospects going forward for those two companies, back in 2017, I was covering the same companies and they were like kind of the small aloe plant. JNJ and PepsiCo now are bigger. They're like the big aloe plant. Same plant, but they're bigger. They've grown in size. But going forward on a forward basis, are the prospects any less? I don't really think so, and I want to share why. I want to explain why in the video today. Get ready, everyone, for an exciting dividend stock investing video. All right, everyone. So I want to go through some of the high-level theory, and then I'm going to get into the model for Johnson & Johnson and PepsiCo. By popular demand, I brought it back. I brought back the whiteboard. You can see it here. Thank you to everyone who suggested this. I'm going all out old school again, and it's so much fun. I want to start with the dividend snowball. I'm going to link in the pinned comment below, but I have some videos on the snowball that I'll link to. But basically what the dividend snowball is it's the magic as to why dividend stock investing works and how it can eventually drive massive cash flow that can be used, dividend checks, to pay the bills and to pay for luxury vacations or whatever the investor wants. There are four main inputs into the snowball. There's net new capital invested. There is the reinvestment of dividends. So when a company pays a dividend, I can take it, reinvest it back. There is also dividend increases. Johnson & Johnson, for example, tends to increase the dividend every year, as does PepsiCo. And last, there is time in the system. You saw that with the aloe plant, just having a lot of time in the system, 7+ years, that plant has grown in size. And so all of those inputs basically go into the dividend snowball, which compounds over time. And as it goes down the hill, it gets bigger and bigger and bigger. And eventually it is unstoppable cash flow. And sometimes some of us get down on the dividend snowball. We get down on it a little bit because we may even have a perception. I'll tell you, going into this video, I was actually planning another video. Then I started doing analysis and I was like, Ian, what you were going to say in the other video, the data actually is pointing otherwise. And that's why it's so important to always look at the data, because when our emotions get into things and our preconceived kind of notions, they may be wrong. They may be inaccurate. And so anyway, I had this perception that, hey, the dividend growth rate for J&J and PepsiCo, it's going way down. And because it's way down, these stocks just aren't as valid as they were back in 2017 and before, like 2010, 2011. I started buying these stocks, I believe, back in 2011, if my memory serves me right. Anyway, what I saw when I did my analysis that I'll share in a minute is I was wrong, but before I even get to that, I want to point out two things in the dividend snowball. There are two factors that are very important to understand. The reinvestment of dividends and dividend growth, they kind of work together as a system. And that's why over here, number 2 and 3, they can compensate for each other. They can kind of compensate for each other, especially if starting yield, dividend yield is higher. When you have a higher starting yield, higher dividend yield, the reinvestment itself can do a whole lot for the snowball. By contrast, if you have a really low starting yield, but you have a huge dividend growth rate, a really fast dividend growth rate, that can compensate for the lack of high starting yield and the lower level of reinvestment contribution to the snowball. So factors 2 and 3, they can kind of compensate for each other. If reinvestment is low because the starting yield is low, the dividend increases, they can kind of compensate for it in the snowball system and vice versa. So that's a very, very important realization to have as it pertains to the dividend snowball. But what I want to share now is my analysis, because this really drives home why I am so optimistic about Johnson & Johnson, PepsiCo, and dividend stock investing overall in 2025 as I was back in 2017. And check it out on the screen. So as you can see on the screen, I have a model here. I have JNJ and PepsiCo. I shared both of these purchases recently on my Patreon. I'm going to link in the pinned comment below to my Patreon where I share my stock purchases. And I share that on both the backyard tier and the corner patron tier. But I bought some J&J on 129. I bought some PepsiCo on 122. You can see on both of these, I see value. I'm excited about J&J because the 2026 forward PE has dipped now into the 13s. And I'm excited about the starting yield at 3.27%. I actually highlight it. PepsiCo, I'm really excited. PE is still a little high. It could go lower maybe, but that starting yield is huge, 3.63%. Anyway, you've seen this before. What I really want to highlight on the screen is the part of the model at the bottom. And so I did some analysis here, looking back at dividend growth rates. Going into this, let me just tell you, let me start with that. I believe right now, going into this, I believed at least that the dividend growth rates for J&J and PepsiCo, they were way lower. They're trending down, going a lot lower than they had in the past, especially when I started buying these stocks like around 2011. When I started buying them, actually I started buying them even before then, but the modern position that I hold now to this day started in around 2011 for both of these. Those positions, when I started buying them, I had a lot of hope, optimism, promise that the dividend growth would be huge. And it was. It came to fruition. But recently, I've kind of been down on things. I've been thinking, Ian, you know what? The dividend growth, it's slowing. Even in the last 5 years, it's slowed. That's what my mind told me. But that's why I did the analysis, because the analysis showed me otherwise. Anyway, as you can see on the screen in front of you right now, I want to start with that. This is really important. So you can see kind of last 5 years, 5 year prior dividend per quarter, going back to about, say, 2020. When we look at that over the last 5 years, on average, the dividend for J&J, let's just start with J&J. It's grown by 5.47% per year on average. And yes, it's trended down on time. Let's look at 2015. If I go back 10 years, what has the dividend growth been per year on average? Well, that's the next row down. It's 5.88%. And if I go down even more, I go down 15 years ago to kind of circa 2010. What has the 15-year dividend growth been? It's been about 6.39% per year on average. So back in the day when I started buying J&J, I received over kind of the lifetime of my modern position so far about 6.39% dividend growth per year on average. Right now, for the last 5 years, and I'm kind of using that to project forward, it's about 5.47. So yes, dividend growth has gone down over time, is what I'm saying, but not quite as much as I would have thought. Not quite as much as I thought. And here's the deal. Let's go back to the whiteboard. remember, I told you that dividend growth and reinvestment, they can kind of compensate for each other. And reinvestment, I put with star there, it's a function. It's a function really also of starting yield, because the higher the starting yield, the more that reinvestment contributes to the snowball. Here's what's interesting. Check it out on the screen. Let's just stick with J&J for a minute, then I'll get to PepsiCo. So on the left-hand side of the screen, you can see over time, the starting yield on J&J has gone up. And so right now it's 3.27%, but let's just look 5 years ago. In 2020, what was the starting yield? It was about 2.83%. Let's go back 10 years ago, 2015. What was the starting yield? It was about 2.73%. Let's go back 15 years ago. Honestly, this was kind of a sweet spot in time. It was 3.11%, but it still had a lower starting yield than now. So what does this story tell us so far? It tells us, hey, Ian, yes, your fear has played out a little bit. Dividend growth is lower. Over time, it's slowed a little bit. Not as much, though, as I thought. Not as much as the negativity that kind of comes into my mind from social media would have had me believe. But the silver lining is the reinvestment component of the snowball is growing. The starting yield is higher. The stock price has adjusted, if you will, for the slower growth in dividends. And remember, number 2 and 3, they're related. They can compensate for each other. And so now with J&J, shares I'm buying right now have a higher starting yield. So that tranche of shares, the reinvestment on that higher starting yield, it can move that system quite aggressively and compensate for this perceived lack of dividend growth. Let's look at PepsiCo because it's a very similar story and it almost illustrates the point better. As you can see on the screen in front of you right now, on the right-hand side of the screen, check it out. So PepsiCo, let's just look towards the bottom right of the screen. Right now, we know the starting yield, 3.63%. I highlight it. What was the starting yield 5 years ago? 2.89%. 10 years ago, 2.65%. 15 years ago, 2.88%. Clearly, right now, investors are being rewarded with a higher starting yield on PepsiCo. And yes, the dividend growth has slowed a bit. As you can see, it was 7.25% per year on average for the last 5 years. And I'm kind of using that to project forward. It'll be similar going forward, if not a little lower. For the last 10 years, it's been 7.54% per year on average. For the last 15 years, it's been 7.63% per year on average. And so you can see with PepsiCo a story where the dividend growth, it is going down slowly over time, not as much as I would have thought, not nearly as much as I would have thought going into doing this analysis, but the starting yield is compensating. The starting yield has gone up. If you will, the stock has adjusted to reflect the slower dividend growth, and adjusting stock price down means starting yield goes up. And if I take that yield and I reinvest it into the snowball, I reinvest it into the system, it plays a big role. Honestly, looking at PepsiCo right now in 2025, I almost feel that as a system, as a snowball, it may perform even better going forward than some of those shares and tranches that I bought in the past, because the starting yield is just so high. It is so high. Even if dividend growth slows, that starting yield really compensates with PepsiCo. And so I overall right now, not just with these two stocks, but with dividend stock investing overall, am very optimistic. And I love the fact that I looked at this data to prove it to myself. It's important to remember, so many of us just look at the dividend growth, and we look at stock charts, we look at capital appreciation. But there are dividend investors out there who subscribe to the Income Factory, for example. I'll link in the pinned comment below to some videos about that, such as my friend Greg, shout out, where they're not even looking for a ton of capital appreciation. Most of the return comes just through the yield. And also, by the way, those distributions aren't growing that fast. It's just a high yield. And the system in that snowball for dividend kind of income factory style investors. Shout out Stephen Bavaria, who came up with this income factory concept. Again, I'll link in the pinned comment below to a book review and to some videos about that, some interviews with my friend Greg. These type of investors, they're getting most of the value of the snowball through reinvestment. They're not getting as much through dividend growth, but the reinvestment is compensating for the lack thereof of dividend growth. Remember, these two and three, they're related. They're related in the system. And so it's the same thing for JNJ and PEPSICO. It's very different than income factory style investing, but we're starting to see these companies mature. They're the bigger aloe plant now, and being the bigger aloe plant, they can still grow. They're still growing very, very well. But what we're seeing is just a little bit of change of dynamic. We're seeing the reinvestment play a bigger role. We're seeing the dividend growth play a slightly smaller role, but the prospects, in my humble opinion, are very, very bright. And so it's important to remember as I close out this video, I put it at the bottom of the whiteboard over here. Look at the data. This is so important. Don't let your mind fool you. Don't let your kind of perceived negativity fool you. Don't let the media fool you. Look at the data objectively and come to your own conclusions. And your conclusions, they might be different than mine. Look, we live in a different world right now than we did in the past. I'm diversifying more than ever. You all know that. I'm looking at new types of investments in technology more so than I have in the past. And it's important to be very diversified in 2025 because our world is changing faster than it did. Faster than it did, for sure, I think, back in 2010 because the pace of the technology is evolving quicker. AI is now really coming to that next level where the AI will be programming AI pretty soon here, it seems. And so we have to be prepared for that. But we also have to look at the big picture. If you enjoyed the video today, please click the like button. It means the world to me. Also, if you've been around since those early days of the whiteboard, of when I was in the corner in my old home, when I was in the backyard in my old home, put in the comments section below. It means the world to me. I really value all of my subscribers and especially the OG subscribers who have been here for 7+ years. Thank you so much. And don't forget to subscribe. I have new videos on the way. Before I go, in terms of a full disclosure, I own the two stocks mentioned today. I'm long Johnson & Johnson, ticker JNJ, and PepsiCo, ticker PEP. Also, a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. Please consult your licensed financial advisor before making any financial decisions. I'm just sharing my journey for fun and entertainment, and it's possible to lose money. I have additional disclaimers in the description below. As always, I love you all. Thank you for watching the video. I'll see you all in the comments below, and I'll see you in the next dividend stock investing video.